really pay attention to that. And give me 5 points on compound interest or the three series, annuities, dividends, and geometrics. So today I'll be covering geometrics very briefly, then we'll just do another accounting problem.
Yay.
Yep.
That's the coverage of the machine.
It is 15 points accounting.
Okay.
Yes. And then 5 points for the compound interest and or the three series, annuities, gradient, and geometric. So that's like chapter 3 stuff.
这还不知道。行情还是错。
So I'm just going to go over some quick definitions for chapter 3, and hopefully get through chapter 3 so very quickly. So for this section, we're talking about different forms of compound interest. So this is just the general idea for Fn is your future worth, your P is your present value, and your In is your interest, basically your interest. So we have the general idea of simple interest, which just adds the interest over your principal amount. But a lot of times in the real world, your interest is calculated based on your present amount, and then is also compounded. So the main difference between the simple and the compound is that the simple is purely based on your unpaid principal amount, whereas your compound is based on your unpaid principal amount and the accumulated interest charges. So that's the main thing, and the accumulated interest charges. So I'm just going to give you a few definitions. This here, that is your future worth factor. In case he asked you on the question or in the exam, I think he asked you a question inside the tutorial. This right here is your present worth factor. This is your future worth factor. And other is your present worth factor. And then you have a series cash flow.
这 B 组是计算范畴，对。
So this is the basic definition you need to know. There's a little bit more for the series. We'll get into when we start doing some questions. Okay, the whole idea is that just always remember that when you're thinking of present, you're thinking at time 0, right? And when you're thinking of future, you're thinking at n, say you're looking at 10 years, n equals 10. So just remember that, because it will be important when you're going back and forth. So, with that, I think we've got to just show you an example real quickly. Number 2. So do you guys have question number 2, Andy? Actually, I think that's a little bit myself. Let me just give you all the formulas real quick. In your textbook, they call this the uniform series, but it's also the same thing as annuity. So your professor refers to it as annuity, but it's the same thing. Okay, so that's all the formulas for chapter 3 that you need to know. If you read your book further, there'll be a section on gradients, but most of the questions he was asking were based on annuity, but also know the gradient was. It's similar to this kind of formula. So what you need to note is that when he's talking in the textbook, he uses this term, which would be, it was here.
哪一个？研磨。一节课出研磨。很草稿的。
So, if you notice here in the compound interest for the present value, we have an alternative way of writing it. You should make a mental note of this because you can either calculate your values, calculate what your interest rate would be, or you can use the values in your textbook in appendix A. So in your appendix A, they write it in this kind of form. So they have you just find the chart before say given your your final value, know your final value, you know your interest rate, and you know the n number of times you're doing the interest. So say you're doing 10% over 10 years, so your I will be 10%, your n will be 10, and if you're trying to find your p, you just then look for the chart that says given that, know this kind of form because it will make your life a lot easier when you're doing your calculations during your quiz. Yeah.
Quick question. What exactly is annuity?
Annuity? Yes. Basically, the main difference here is that this is a simple sum. So you have your, the cash flow would be and this is year 0. So this is considered your P, and right here we considered your S, right? So for a single sum, from this side of the board, if you are given a final value at year 5, what would it be worth right now in the present time? So that's basically what this formula is telling me. That's the equation for the formula. So if you go backwards, if you want to put in a certain amount in the bank, and you want to see what that amount would be in the future, you can use this too. Now annuity has this kind of cash flow. Okay, so the first one was a single sum at the final year. This is basically same payments across the year. So say you had a loan and pay $200 per year. That was considered 200 per year for 5 years. That was considered an annuity. You're paying the same amount over and over every year, not including year 0. So that's the main difference of annuity and single sum payment.
Annuity doesn't include the interest?
Annuity includes the interest. So the interest will be calculated based on the fact that you're making your payments, the same amount of payments every year. So it incorporates the interest charge with the formula. But this one is just a one-time payment, right? So you're just basically bringing the value of something in year 5 to the present, or vice versa. I don't know, does that make sense?
So we're assuming that in year 0, you don't have any, like, you're not doing any investment? Like, it should be 0, and then when you get the formula?
Yeah, that's the general idea. It's like, even though it says year 0 doesn't mean right now. Right now, I didn't make a payment yet, but I'm going to make a payment every year. So it just starts right now before you make a payment, basically. I know it's kind of hard to grasp, but that's just the general form. But it's an important thing to remember because when you have questions where you have a combination of an annuity and a single thing, just always remember this form. So your first thing will start like year 1 and then go onwards until the end. When we do an example, you can see it a lot easier. So that's like the 2 forms you should remember. Okay, and yeah, once again, also for the annuity, you can calculate it based on this way, or you can find the number in your textbook in the appendix. So it will be under annuity chart given A, find P. So that's similar kind of stuff. So just if you want to use the textbook way, it's probably the easiest way. Just become very comfortable with it, and make sure you're looking at the right chart. Because each chart is based on the interest rate, each page. So make sure you're on the right interest rate, and that's the right number of years or months, whatever payments you're making. Okay. So with that, we're just going to jump into a problem, and we'll become clear very soon. Okay, and the other definition I have here is effective interest rate, which R is basically the interest rate that you're making, and M is the number of times, you're making that interest rate. Once again, once I show you this problem, it'll make sense.
不讲规定，同学我们来去。
Okay, so we're going to jump to question 2 in the current tutorial. Okay, so this is a question based on the effective interest rate. It says that there's a loan shark who said that his interest rate is not bad. He only charges 1% interest per month and only a small service charge. And for a loan of $5,000, you have to pay back over 30 months. And they wanted to find out what would be the effective annual rate if you had to make 255 payments per month. Okay, so the fact that we have to make 255 payments per month, that should be a clue that this is also an annuity policy. So every time we make the same amount of payments every time, it's an annuity. So just use that formula. When you use single sum, just use annuity. Okay? So our loan is 5K. Our interest is at, so our loan is 5K, so that should tell you that's what our actual principal is going to be. So if you just use the formula, yeah.
这样他已经给答案了吗？后边是吗？关注这后边。
Okay, so this question, they want you to find what the annual interest rate will be. We're using the annuity formula to find our I. We know our payments are 255 every month.